Hi, my name is Don Burrows. I'm a financial advisor with Hilltop Securities in League City, Texas. And today we want to welcome you to our inaugural version of Business with Burrows. And today I'm excited to bring in one of our own from Hilltop Securities. We're going to have an interview with Scott McIntyre, who is Managing Director and oversees Hilltop Securities Asset Management, affectionately known here internally at the firm as HSAM. And Scott has been with the company many years. They run about $13.5 billion in client assets. I believe 100% of those are municipalities, cities, school districts,
Correct.
public funds. And Scott, tell us a little bit about you and your group. I know you've got a great team there, and then we'll kind of get into it.
Well, as you mentioned, I've been here for almost 23 years. Before it was Hilltop Securities Asset Management, it was First Southwest Asset Management, and I do work with a great team. I've been in the business for over 30 years. We manage local government funds, both operating and bond proceeds, reserve funds. It's all short fixed income. It's kind of boring stuff. I've been doing this again for 30 years. I was with the Texas State Treasury years ago. And recently I feel like I've drifted over from hands-on managing funds to actually doing a lot more in terms of economics and looking at interest rate forecasts. And that's really, as much as anything else, what I'm doing day to day. I read a lot about what's going on and try to figure things out like the rest of us.
And that's great, because I tell you what, from my team's perspective, Scott, we really enjoy the commentary that you and your team put out. So for our clients, Scott puts out every time there's a major economic release, they put out their commentary to give a little bit of color on what those releases mean with respect to the markets and the economy. And you'll be able to find that in the link below in the description of this video. And it's basically hilltopsecurities.com/public finance/economic commentary. But we'll put a link in there where we'll make it easy for everybody to go. So with that, Scott, what I'd like to start out with today is, my goodness, the presidential election. What a wild week it's been. And on top of that, we look like we might have a vaccine for COVID. Please elaborate.
Well, there's a lot to cover there. There's a lot of noise. So we did have a presidential election. It's not completely clear that it's over yet. And, things have been shifting so rapidly. At one point, it looked like it was going to be a blue wave, that the Senate was going to go to the Democrats. And what that implies is that, if you have control of the House and you have control of the Senate, then what you want to get done gets done. So what that would have meant is a large stimulus program or additional stimulus program, probably some infrastructure spending, a large infrastructure plan, possible rollback of at least a portion of the tax cut from a couple of years ago. But then as the elections unfolded, it appeared as though that blue wave didn't come, and it appeared as though the Republicans would retain control of the Senate. But what's happened in recent days is it appears as though it could be a split Senate, because there's a runoff in Georgia, and it's a very, very important runoff. My thought on that is that there's a number of folks, a large number of Americans, over 70 million had voted for Trump. And if Trump isn't elected president, the question is, who comes to actually vote on the Republican side for the Georgia Senate races? And honestly, it could go either way, but if both of those seats go to Democrats, we have a 50-50 Senate. And of course, the tie is broken by the vice president, which effectively gives control to the Democrats. And they still have a slight control of the House. And what that suddenly implies is that there could be, more robust spending in 2021. As far as the virus is concerned, and then that's a great question, because we just heard yesterday that Pfizer had announced a vaccine that's 90% effective, which is, I think that exceeds most people's best expectations. But then the question suddenly becomes, there are 7 billion people in the world. I mean, who gets it? When does it come? When's it available for us here? And the answer seems to be that for most of us, that vaccine won't be available until the spring or early summer at the earliest, which means that COVID's not over. We do have the highest case increase, the highest number of new cases now than we've had at any given point, and that does affect things. As much as we'd like to think that the all clears whistle's been blown, it hasn't. And
Yeah,
we
I
need
agree.
to. I'm sorry, Don. Go
No,
ahead.
I totally agree. I mean, we have gotten a few things behind us, Scott. The election is behind us, but yet we've got, a very real potential for lawsuits, which I think the Trump administration has already started filing. And with this runoff that you'd mentioned in Georgia, I think it's December 8th. Is that the date that the runoff is?
January 5th is when we'll see that runoff. So we have a ways to go.
Yeah, so even though we've got these things behind us, we really still don't have 100% clarity as to which direction or who's going to ultimately be in power in Washington, D.C. So that's yet to come, folks, and I think we'll have more information on that.
Don, as you and I had talked about, just to add, I was thinking last night that, there's actually less clarity now than there was election week, which is remarkable considering we had an election. So, there's going to be a lot that happens. It's going to unfold over the next couple months.
Yeah, I can safely say I think we'll continue to see heightened levels of volatility both in the bond market and the stock market. So hang in there, folks. We'll get there eventually. So with that, Scott, one of the things that I love when I'm reading your reports, and I read them every time you put one out, and my team does as well, is let's kind of talk about the state of the economy. We had a massive moves earlier this spring and in the summer in the GDP numbers. Can you highlight that a little bit and talk about the previous quarter's GDP to start out with?
Sure. So, of course, we wound up falling in terms of GDP in the first quarter, which is somewhat of a surprise. Second quarter GDP was actually down by 31.4%.
Wow.
That was an absolute record. Never seen anything like that before because the economy shut down. Most of the economy anyway. And then what we got very recently was the third quarter bounce. And that third quarter bounce was enormous. We were up by 33.1%. A couple things to keep in mind is that first off, that bounce was fueled by 3.5 trillion, in government spending, which is not likely to continue. We started out from a really deep hole when we were climbing out in the third quarter. So, really what you look at when you look at GDP is from point to point. So you start out low, you move back toward where you were. Now, granted, we're still down 3.5% on the year, but
Right.
That was a big move. And on top of everything else, it's quarterly, seasonally adjusted, and then annualized. So it wasn't really a 33.1% increase. It was actually 7.4% year over year. But there's a lot going on in the economy. We have to acknowledge that the increase was spectacular, that we've come back a lot faster than we expected that we would. But by the same token, we paid for that. We paid for that increase with our spending.
Yeah, and that brings me to my next question, Scott. It's we've heard a new term this year. It's always been V-shaped recovery. And this year we have been hearing more and more, and my phone's been ringing off the wall with my clients. Don, what is a K-shaped recovery? Scott, can you elaborate on that?
Yeah, absolutely. So the K-shaped recovery includes the V-shape, if you think about the shape of a K, but it also includes a large number of people who didn't benefit, who haven't recovered. And then that's really what it's referring to. So, you've got and we'll talk about employment a little bit later, but you have a large number of people who are still unemployed. You have a large number of folks who were given unprecedented federal assistance, specifically to the tune of additional unemployment benefit of $600 per week, or roughly $2,500 per month for folks who've been unemployed, and that ran out at the end of July. So the K-shaped recovery really refers to the haves and the have-nots, and the haves have done really, really well. Those are the folks who own stocks, Those are the folks who kept their jobs and are able to work remotely. But if you're in the service sector, even you and I had talked about it earlier, but service sector jobs, the airline employees, the folks who work at hotels, the folks who cut your hair, the yoga studios, the gyms, the folks who work in conferences and sporting events. I mean, all of that is sidelined and likely to continue to be sidelined for a while. So, they're the flat line on that K-shaped recovery, but clearly K-shaped is what's happened.
Yeah, and that's a great explanation for it, Scott. And essentially what you said is just the recovery hadn't been equal for everybody. So we look forward to keeping track with that. And, if we have this vaccination, I do think that'll help these service workers, airline workers, everybody that you had mentioned, including my yoga instructor, to start getting her shop back and open, and many others as well. Also on the state of the economy, one of the things my team and I look at and we talk to our clients about all the time is the federal debt and the deficit. And as you know, Scott, when we spoke earlier, the United States of America has a debt now of $27+ trillion. Can you elaborate on that, and what's that mean for us long term? What's it mean for us short term, and who's going to pay the piper?
Yeah, and that is there's so many tangents. You and I talked about that. There's so many rabbit holes you can go down, but this is one we need to talk about. As you mentioned, 27 trillion is where the national debt is. That's increased over the course of the last 4 years by about 8 trillion. Now, much of that is a result of the pandemic. When the government spends money, in essence, we'll eventually pay for it. And the hope is that the economy gets to roaring so fast, the tax revenue comes in and pays this back over time. But I don't know that necessarily is going to be the case, because going forward, GDP growth is probably going to be very, very moderate for the next few years. I mean, we'll talk about this maybe a little bit later, but I think 2% is probably, a realistic long-term expectation. So the question is, with $27 trillion worth of national debt, are politicians suddenly going to become fiscally responsible and say enough's enough? That, we have seen a big rapid recovery. Maybe not all the way, but we've seen more than we would have expected. Should we just let it run, without adding additional stimulus? And that's going to be a question going forward. And a lot of that, of course, is going to depend on the Senate and whether or not the Republicans hold an advantage, or whether it's a 50-50 Senate controlled by the Democrats. But that definitely would be something that I think will come more and more into focus, in the coming years. And one thing I do want to mention is that, a lot of other countries have extraordinarily high debt, higher than we do on a debt to GDP.
Japan. Yeah.
Japan is a perfect example. And if you go back 20 or 30 years and mention that this is going to be the case, you would think that, that debt would ultimately sink the economy, except that Japan has been in a zero rate environment for decades. So if you're not paying interest on your debt, or you're paying very low interest on your debt, you can sustain it for a much longer period of time. And
absolutely.
Absolutely.
Yeah. I mean, and you and I had the conversation last week about, I don't necessarily agree with it, but there's a book that's been recently put out about making a case for MMT, or modern monetary theory. I believe the name of the book is The Budget Deficit. And, I went into it very skeptical, and I still do not believe in MMT. But the author of the book, did a fantastic job at explaining how it should work. And, unfortunately, I think there's a case to be made. We've been in a bit of MMT for a number of years now. But anyway, moving on, Scott. And by the way, Scott put out a great report that can be found at the website I mentioned earlier, called the Historical Third Quarter GDP Report and Beyond. I invite you all to go to the website and download the report and take a look at it. But moving on, Scott, let's talk about the labor markets a little bit. They've been bouncing around. Let's start with a review of total non-farm payrolls.
We just got a report on Friday. It was the October labor market report. It was much anticipated, and we actually had 638,000 jobs return to non-farm payrolls, which ordinarily would be spectacular. That is fantastic job growth, but this is not really job growth, it's jobs returning. So during the month of March and April, there were 22 million jobs that left non-farm payroll. So 22 million people were let go. And then over the course of the next, 6 months, those jobs have returned. A lot of those jobs have returned, 12 million of them. But we still got about 10 million that haven't returned. And the pace of those jobs that were returning has definitely slowed down. And most of the folks that got laid off initially were service sector employees. And, as we mentioned before, they have been slow to return, and there's no real reason to expect that, the return of the jobs is going to increase, markedly over the course of the next several months as people hunker down for the winter. Unemployment rate, we peaked in terms of unemployment at 14.7% in April, and historically that is extraordinarily high. Gradually, as we move forward, that unemployment rate has fallen, and it fell from 7.9 to 6.9 in this last report on Friday, the October employment report. And, the Fed in June, when they looked at their projections, they thought that we would end the year at 9.3. So if you want something to celebrate, if you want to nod your head about how well we've done in terms of getting things back together, I mean, that's a worthy thing to celebrate. It didn't wind up being 9.3% at the end of the year. We're not even there yet. It's 6.9. But, these are folks that are actually looking for work. You don't get included among the unemployed unless you're looking in the last 30 days. So that's sort of
we're going to pull up a graph, Scott, and it's
okay.
Your graph called the unemployment rate, the U6 underemployment rate versus the unemployment rate. Can you talk about that and explain to our visitors a little bit about what that means and why it's higher than the unemployment rate?
Sure. So the U6 measure is much broader, and what that includes, to make it as easy as I possibly can, that includes everybody who is working temporary jobs or part-time and would prefer full-time, which is a pretty large portion of the population. It also includes people who are not looking for work, but if a suitable full-time job were offered to them, they would take it. So, these are the people who would like to work full-time, and it's a much broader pool, and obviously at 12.1%, it's higher.
Right. And so that, I guess, leads me into my next graph that we have for you, which is unemployment claims around continuing. And that's a number that I watch very close. I mean, the unemployment number is going to move up and down, but it's that continuing claims number that concerns me and that I am still a little bit cautious about. Can you elaborate on that?
Sure, absolutely. And that is something all of us are watching right now. Initial unemployment claims are first-time filings for unemployment benefits, and you file with your state. So last week, and they come out every week, but last week that number of new filers was actually 751,000, or 750,000 people lined up for new unemployment benefits. These are people who lost their jobs and they're filing for the first time. Before the pandemic, that weekly number was closer to 200,000 per week. So it is still incredibly elevated.
Yeah, wow.
And continuing claims, Don, you had mentioned, that's about 10 million roughly, and that's moving sharply down too. But you can't take too much solace in that because after 26 weeks, you're no longer eligible for state benefits. So they're dropping off. They're not necessarily finding work, but they're dropping off. And if you are no longer eligible for state benefits, under the CARE Act, you're actually eligible for an additional 13 weeks of federal benefits. So if you look at the state benefits plus the federal benefits, we're still at about 21 million people receiving benefits. So again, we can celebrate, but there's some issues.
Right, and here in the great state of Texas, unfortunately, we just heard, I guess 2 weeks ago, Exxon was having big layoffs going across the oil patch, here in Houston area, especially, and Scott, I know you're in Austin, we continue to have week after week of new announcements of layoffs. So hopefully that will improve and things will continue to get better on that front. And we will keep everybody up to date on that aspect of it. And Scott put out a new report. He puts them out just about every week on the unemployment and the employment picture. So again, you can go to his website and pull that report down. So Scott, one area of the market that has actually been a shining star this year has been housing. It has been a bull market in housing. We're starting to hear that word bubble again. And, I'm just glad that we've got an area of the market that's doing well. But, when we look at your graph that shows 30-year mortgage rates, let's pull that one up, Fabian. And then right here, you can see that 30-year mortgage rates have basically been a big impetus on stronger housing. Is that it, or is there more to it than low interest rates, Scott?
That's a big part of it. It certainly helps when the 30-year is averaging 280, which was a record low from a couple weeks ago, according to Freddie Mac. The 15-year fixed rate is around 230, again, record low, and that's very, very helpful. I think if you would have asked anybody when this pandemic began what they thought the chances of a housing boom would be, and most people would have said no chance. But what's happened is folks are fleeing the big cities for the suburbs. I mean, you probably have read that a million times, and there's a lot of truth to that. But then you also find that people who are working from home and expecting to continue working from home recognize that they can work anywhere they want. You can work from the mountains of Colorado. You can work from the coast, anywhere you would like to work. But again, this is the haves and the have-nots. The folks who are unemployed, they're not jumping into the housing market and buying a second home. So, and I do believe that to a certain degree there is some front loading. There's a lot of folks who have rushed out and bought homes that probably won't be buying homes in the spring. So inventories right now are lean because there's been so much demand relative to supply. So builders feel great. They should. Home prices have moved sharply higher. Again, supply-demand issue. It's a very good market as far as interest rates are concerned. So builders have broken ground at record paces for building permits and housing starts, maybe not record paces, but the most in a decade. New home sales and existing home sales are at 15-year highs right now. And, it is a really good market for that. Housing has helped a great deal, been a big assistance in terms of a third quarter growth. It's going to continue likely into the fourth quarter. And to some degree, I think there's going to be housing momentum that carries forward into early 2021.
And that's a good point, Scott, because a lot of people don't know this. My family and I have a small farm near Nacogdoches, Texas, and we grow timber. And that timber is put on about a 5 or a 10-year rotation, and it's brought to the mills, and they make lumber. They make building products out of it. And over the last 5 months or so, lumber futures have skyrocketed a couple of times. They've since come back down. But even if you've gone to the store to buy plywood or 2x4s, you're seeing a 2x or even 3x increase in prices of raw building materials sometimes. So my question is, does that increase in building prices offset these low interest rates?
To a degree, I think it does. I mean, the low interest rates are always going to help. They do make a big difference. I do believe that a lot of the price increases, because everybody's rushing for the door at the same time, the supply hasn't caught up with the demand, and eventually it will. And there's other building materials that can be used instead of lumber. I mean, a lot of steel framing is going up. And if there is an infrastructure, I can promise you there'll be a lot of steel manufacturers that are knocking on the doors of the home builders.
Yeah, and what you said about everybody leaving the big cities, I mean, we're even seeing it here in Texas, where, again, my farm is in East Texas. My bankers up there, as well as some real estate friends, have told me that there has been more demand for acreage between 10 and 200 acres. People are buying it up and moving from as far as Nashville, Tennessee. And why? They want to get into rural America. They want to get away from the cities. I mean, we read about it, we hear about it nationwide, but when you see it in a small county in eastern Texas, it just really hits home.
Yeah. Makes sense.
Let's talk a little bit on housing again. So another thing that we read about and we continue to talk to our clients about is the forbearance. not just in mortgages, but also in the rental market. Can you kind of talk about that a little bit? What's that build up and what can we expect to see as a result of that forbearance?
Yeah, and I'm glad you asked that question because again, there's so many different tangents and angles to explore. But one of them is that the CARES Act allowed folks who have mortgages, government mortgages, to be able to defer those initially for 6 months and then another option for another 6 months. And initially there were about 6 million people who took advantage of that. It's down to probably 3.54 to 4 million at this point in time. But if you're not paying your mortgage, if you've taken the opportunity to the forbearance opportunity, you eventually do have to pay that. And that's the same way with student loans. So there was a student loan opportunity to hold off on your student loan payment for up to a year. And from what I understand, from what I read this morning, that number of students who have taken the opportunity to defer that is about 80 million loans. So between the home loans, auto loans, the number there is somewhere in the neighborhood of 7 million. You also, and this sort of is another thing we didn't talk about, which sounds like a paradox. But, at the same time, the housing market is booming. You have folks who are renting who are really, really hurting. And, the CARES Act allowed you to defer your rental payments up to a point. And then the CDC stepped in September and pretty much took up the slack. So there are a number of people, estimated between 30 and 40 million, who are not paying their rent right now, who eventually will have to pay not only, the rent they didn't pay, but also the rent that, going forward. And, these loans that are not being paid that eventually are going to be a weight at some point on the economy going forward. We don't know how that's going to play itself out, but, we really do need to mention that all the spending that's gone on by consumers that's driven economic growth, the impetus, the fuel for that, the idea that you're not paying your mortgage so you've got more money to spend, that's not forever. But it is a really good point. I'm glad you brought it up.
Yeah, and we keep hearing the talk of more stimulus, but I think with the uncertainty we still have in the election results, with the pending runoff that we're going to have later in the year, and Georgia is going to have a lot of outcome on whether we get any stimulus or not. So, Scott, I think from our conversation today, we can safely say that things are a lot better than they were back in the April-May timeframe when COVID first broke out. But I think structurally we still have a lot of wood to chop. We need to get this election finalized and put behind us. We need to get these runoff elections put to rest, and then I think we can finally have some clarity as to which way the economy is going to move. And Scott, I can't thank you enough for spending about a half hour with us this morning and talking about some of these higher macroeconomic indicators that you and I both watch. And I want you to make me a promise, bud.
Sure.
I want to have you back on. I want to do this maybe quarterly or something like that. Because our goal with this program is to better educate both our private client investors as well as our institutional investors. And Hilltop Securities has really put together our two legacy firms, First Southwest Company and Southwest Securities. We're now known as the leading municipal investment bank in the country. And I think we have a great group of businesses here. And I like the fact that I can pick up the phone, call our head of economic commentary, and get Scott on a call for the benefit of not just my clients, but the Hilltop Securities clients. So, my friend, keep leading the herd in the business that you do, in the infamous words of our leader, Brad Wingus. And I look forward to having another conversation with you soon. So, folks, again, if you want to pull down Scott's commentary, go to hilltopsecurities.com/public finance/economic commentary. The link is below in our description. And also remember to hit the subscribe button on our YouTube channel. Follow us on LinkedIn, follow us on Facebook. And until we meet again, Scott McIntyre, thank you very much.
Thank you, Don. I appreciate it.
And come to League City, Texas and see us sometime. I know things get a little crazy in Austin, but when COVID's over, we'd love to have you down here. I think you've got a few clients in my neighborhood.
Love to. I'll help you chop wood.
All right. Thank you, sir, very much. Have a great day.
You too, Don.
Folks, until our next rollout of Business with Burrows, thanks for joining in. Remember again to follow us on all our social media sites, and thanks for coming. We'll see you the next time.